Focus brought to you by IG, taking a look at US dollars current prices versus the euro, yen, pound, all the major currencies there, and seeing if now might be the best time to hedge. We've seen historically high prices for a dollar in the last couple of years since inflation spiked in 2021, 2022 range. The U.S. raised their interest rates fastest and most aggressively compared to other global economies. And the U.S. dollar ran up to historic extremes to the tune of, 5 years, 10 years, in some cases 30 years relative to that yen, which we'll get to in a little bit. And now the story is turning a little bit, right? Inflation's moving lower. Interest rates are moving not necessarily lower yet, but they're kind of topping out around 5% in the US and plenty of places globally. Has a lot of people wondering, is this the high in USD, which of course have no clue, but is it a good time to hedge that US dollar exposure, be it for, personal reasons, for business reasons, or for just trading speculation? As we're starting to see some weakness in this dollar, especially recently on November 14th, the worst day of the year for US dollar compared to pound and euro, gave up more than 200 pips against the pound in one day. That's 2 full pennies as it moved from around 123 up to 125. And that's to say, for every pound you get before the 14th, you could have gotten $1.23, and then after the 14th, you could have gotten $1.25, which might not seem like a lot, but that's a lot, especially when you scale up into the, thousands of pounds type area. And again, is this a blip on a continued path of US dollar strength, or is this the market turning over a little bit? Well, let's first look at how we got here and then address whether or not it's sustainable that the US dollar be near to parity with the pound and euro, or be at those 150 highs against the yen, which it's been trading at for the last couple of weeks here. But first, why is the US dollar starting to weaken? And it's weakening for the same reason that it was strengthening over the last couple of years, which is US rates. And they're projected to fall from the CME group here, Fed funds futures, for the end of 2024. So the next year out, projecting that rate cuts are very likely, and actually only a 0.2% chance that US rates stay where they are. On the flip side of things, if you want to view it a different way, 99.8% chance that US rates are lower than they are now in December of next year. And so with this shift from a rate hiking environment in the US to a rate cutting environment, the US dollar has given away some ground. And how much US rates are lowered by could be indicative of how much the US dollar, how much ground the US dollar gives to euro, pound, and yen. And historically, you've seen rates in the US fall much faster than expected. As, for example, you had the pandemic where the Fed came out and cut from around 1.5% to 0 in 1 month in March of 2020. You go back to the financial crisis of 08, and interest rates went from 3, 4, 5% to 0 over the course of just a few months there. And Now, that's a small sample size, and of course, the past doesn't guarantee anything. It doesn't necessitate that that's how we have to go. But historically, you have seen rates fall faster than currently projected. You know, looking at these historical cases of the pandemic and the financial crisis makes a fall from 5.5% to 4.5%, which is around about approximation of what's projected for the next year, for a year's worth of action from the Fed, makes it seem relatively small. And if you were to kind of extrapolate from there, moving in 2025 to around 3.5%, would still be, you know, way more calm than cutting from 1.5% to 0 in a month, or going back to the financial crisis, you know, cutting hundreds of basis points over the course of a few months. So that's the way that it's mapped out. And I guess, you know, just to throw on top of there, historically, we actually haven't seen such a quick rise to interest rates as we've seen over the course of the last couple of years here. I mean, they hiked over 500 basis points over the course of essentially, you know, a year and a half, whereas from 2016 to 2019, they could only hike around 200 basis points, and that took all of 3-4 years. And so this could be a new environment. We have, like I say, the historical pieces, a small sample size, and this is a little bit different than it was in the 2010s or in the aughts. So maybe this fall off in rates is a little bit slower, but if it is fast, it can move the demand for forex very, very quickly, as demand for currencies are really a function a lot of times of interest rates in the two regions. And the example here being, you know, Australia's interest rate right now around 4%, Japan's interest rate right now around 0%. Well, if I'm long Aussie and I'm short yen, then my long in the Australian dollar is getting 4%. Of course, you know, brought down for an overnight rate, but essentially 4% annually. My yen piece that I'm selling to buy Aussie, I only have to pay 0% on that. And of course, fees and everything else can be included in holding these positions. But theoretically, you see relative strength in these pairs between these currencies, a lot of which that's based on higher rates, and, you know, relative weakness based on lower rates. And so then you take a look at the current landscape for global interest rates, and it might not surprise you that the U.S. has had the highest interest rates of these global economies. Makes sense. U.S. dollar has been up on each of these regions' currencies, except for Switzerland. The Swiss franc has been quite strong, but that's kind of a different story. And so what would happen if the U.S. went from 5.5% to 4.5%, to kind of middle of the pack, or if rates fell faster in the U.S.? Well, all else equal, of course, you would expect that if the U.S. is hurting, that the UK and Canada and Euro area and Australia would be hurting as well. So maybe they'd be moving interest rates lower as well. But all else equal, if something were to happen where the U.S. cut rates faster, then you might expect the U.S. dollar to move lower as well. Now, that being said, if Canada, for example, cuts their interest rates very quickly, or the Euro area cuts their interest rates very quickly, and the U.S. doesn't, then you could see continued dollar strength. But you're starting to see the dollar turn over a little bit on the idea that they might be moving to the middle of the pack, or even lower than the middle of the pack. We've seen a lot of strength in pound and euro over the course of the last couple of days. And, you know, looking at dollar versus yen, really anything can help this yen piece at this point. Because I know myself anecdotally over the last couple of years, so many friends and family members traveling to Japan. It's like, man, why is that going on? Oh, well, because the dollar is at 30-year highs against the yen. And of course, Japan, beautiful country to travel to. But it begs the question of, how sustainable can this be? And even if U.S. rates go from 5.5% to 4.5%, a moderate fall in the next year, and Japanese rates stay at, negative 10 basis points, essentially 0%. They continue to show the same economic landscape that they've shown amid U.S. hikes, then maybe the dollar finally comes off of these 30-year highs against the Japanese yen, as essentially that story would be, Japan and the U.S. on the same level, 0% rates. U.S. goes to 5% rates, and it comes back to somewhere in between, and the U.S. dollar is able to gain some strength, or is able to lose some of that strength that it's gained against yen over the course of the last couple of years, all else equal. Now, something that's maybe a little bit more nuanced is this euro piece, for example, whereby, they both went from 0% to 4 or 5%. And now if the US falls a little faster, then the euro maybe gains some strength off of that. If Europe falls faster, then the US dollar might get back close to parity. But either way, you look at the grand scheme of things and ask whether or not it's a good time to hedge. And it really boils down to whether or not you think this is a new market environment where the U.S. dollar will just continue to strengthen, and U.S. data and U.S. interest rates for the foreseeable future will be stronger than these global economies. Or if you do subscribe to mean reversion and you look at the euro versus the dollar for the last 30 years, and you've had prices below parity, you've had prices up above 150, and now sitting closer to that parity around 108, 109, then you might think that this U.S. interest rate story and U.S. dollar will revert to middle of the pack. It could be a good time to hedge for, either personal or business or trading purposes. What is also another interesting piece to throw into this equation is the fact that majority of traders are short this U.S. dollar when looking at that extreme dollar versus yen. 80% of clients with positions in dollar yen are short that U.S. dollar. So thinking that there will be a reversion to more normal prices, and this U.S. dollar and U.S. rate story will move back to the middle of the pack at least.